AMD is currently trading at $76.48. What if I told you there's a trade you can make today where 1 week from now you could have two possible outcomes? You could either own AMD at $73, which is a 4.5% discount from the current price, or get a 2.6% return on capital invested, which is 279% annualized. Well, it's true, and the secret is cash secured puts. So what are they and how do they work? Let's get into it. This is the Hourglass Trader, where as time passes, we make money. So let's first back up for a minute and look at what a put is. By definition, a put contract gives the buyer the option to sell a stock for a predetermined price. Here's what that looks like. Let's say we have stock A, which is trading for $100 a share. Along with stock A, we also have a 95 strike put contract trading for a $1 premium. We also have two parties here, the buyer and the seller. Now is also a good time to remind you that each option contract is worth 100 shares. So the 95 put in this example gives the buyer the right to sell 100 shares for $95 a piece. This in turn means that since it has a $1 premium, the buyer must pay $100 for this contract. To take another step back really quickly, why would a buyer want a put in the first place? A put contract is generally purchased when you think the price of a stock will go down. So let's say the buyer thinks that stock A will go down to $90. If it does, he'll be able to purchase stock A in the open market for $90 and exercise his right to sell it for $95. This creates a $5 gain per share. Since we know that each contract is for 100 shares, this represents a profit of $500 total on the trade. Now this is netted against the premium of $100 that the buyer paid, so it's really only a $400 gain, but the purpose of this is to demonstrate the idea of how a put works and where it derives its profit from. So at this point, you might say, great, I get that the buyer will make money if it drops down to $90, but how likely is it that the stock actually drops down to $90? And typically, the answer is that the odds aren't good. So let's talk about the seller. Assuming that this contract expires in just over a week from now, these are the most likely outcomes. As you can see, the potential outcomes that result in profit, mostly max profit of $100, far outnumber the potential outcomes where the buyer makes money and the seller takes a loss. So looking back at the transaction that we outlined, you're far more likely to make profit as a put seller than a put buyer. So that's the approach we like to take, using a strategy known as selling cash secured puts. You may not be familiar with it, but I can guarantee you that you're likely familiar with one of its biggest fans, Warren Buffett, who used this strategy while accumulating his profitable stake in Coca-Cola. With all of that in mind, let's get back to the AMD trade that we teased in the beginning of the video. Here's a screenshot of the option chain. For our example, we're going to use the 75 put expiring on October 2nd, just over a week away from today. When we sell puts, we like to capitalize on the extrinsic value of the put, which will completely dry up by the time it expires. When you sell an out-of-the-money put, 100% of that put's value is extrinsic. This $75 put is currently selling for a premium of $2, so let's do some math here. Again, with this trade, there's really only two potential outcomes. AMD either finishes above $75 or below $75 per share upon expiration. So let's look at option number one, which is AMD finishing above $75 per share. Conceptually, we know that if it finishes above $75 per share, the put we sold will expire worthless and will collect max profit. Max profit is our $2 premium times the 100 shares per contract for a max profit of $200 per contract sold. From a return on investment standpoint, let's look at what kind of return on our money it is. To sell these puts, cash secured, it means that we need enough money to cover the assignment or purchase of the shares in the event that AMD drops below $75 and our contract is exercised by the buyer. This is simply calculated as the $75 it would cost to buy each share times 100 shares per contract. So the collateral per contract sold in this case is $7,500. Therefore, a $200 return on a $7,500 investment is roughly 2.67%, and that's just for 1 week. Compounded annually, that's a return of just under 300% a year. But let's look at scenario number two, which is what happens to us if AMD finishes below $75. In this case, our options will be exercised and we'll be on the hook to buy 100 shares for $75 a share. That comes out to a total of $7,500 paid for those shares. But you've got to remember that we still receive that $200 premium no matter what. So when you net that against the money paid for the shares, we've actually only paid $7,300 for the shares, which divided by the 100 shares purchased gives us an adjusted basis of $73 per share. With the price today at $76.48, that's a discount of 4.55% per share. And remembering that we're selling these out of the money, there's a far greater chance that we're going to hit max profit than be assigned the shares. In fact, let's take a look visually at what that looks like. We're using optionsprofitcalculator.com here, which is a great way to plug in potential trades and see their potential outcomes. When we put in the example that we've stated here, there are far greater outcomes on this chart where we get profit than when we make a loss. And that's the advantage of selling cash secured puts. So there you have it. The idea behind selling these cash secured puts is relatively simple. Pick a stock you like, sell the put out of the money, and then sit back as you either collect option premium or receive a sizable discount on shares of a stock that you already would have been okay owning at the current price. And while max profit or a discount on the stock are the two outcomes you'll see if you hold these puts until expiration, there's also another position you'll find yourself in where the stock has dropped below the strike price you sold at, but you're still profitable. In this situation, it's usually best to close out your puts for a profit and sell at a lower strike for the following week. This is known as rolling your puts, and let's take a look at when this is a good idea. So back to the spreadsheet, we've got the $2 premium for the $75 strike up here again. We know that if AMD finishes above $75, the put will be worthless and will hit max profit. But what about below that? When a put hits expiration, the value of the put, if it's in the money, is the difference between the strike price and the stock price. Knowing that, we can calculate our profit or loss on everything below $75. Since we paid a $2 premium, the break-even price on the trade is $73. So between $73 and $75, we won't have max profit, but we would still have made some money. In these situations, I always recommend taking that profit and then selling puts again the following week. If AMD finishes at $74, take the $1 profit, which is $100 per contract sold, close it out, and sell at a lower strike like 72 or 73 for the following week. This lets you 1. Collect a profit for the current week, and 2. Set yourself up with the exact same situation the following week where you either hit max profit or receive a solid discount on the stock, except this time your max profit will be above 72 or 73 instead of 75. Theoretically, as long as it drops slowly enough, AMD could go down to 0 and you still profit off it every week. Now obviously that isn't likely, but that just demonstrates the value of selling puts. If it drops below your break even and your puts move in a position where you're at a loss for the week, that's when we recommend taking assignment. Your basis will be $73 on the shares, but it's an unrealized loss, which we have several other option selling strategies we can use to quickly recover it. So while selling a 75 put really is a one or the other type situation, you will sometimes find yourself in scenarios like this where you're not at max profit but still making money. Taking profit and rolling your puts over to the following week at a lower strike is how we recommend you handle that. So a few days have passed since the initial situation we laid out in this video, but AMD puts still offer good returns with about 2.3% at the money and over 1% per week, just a few strikes away from the current stock price. Now these are undeniably great weekly returns as they compound into awesome annual returns, but let's look at a stock like AT&T, which has the ticker T. You'll notice that the returns for these puts is almost non-existent compared to AMD. So why is that? The answer is that not all stocks are the same when it comes to selling puts. Certain stocks offer much greater returns due to variables such as implied volatility. So how do we find stocks that offer great returns like AMD while still managing to keep our risk down to an acceptable level? We'll talk about that in part 2 of our put selling series as we dive into finding and picking the right stock to sell puts on. Until then, subscribe to our channel if you haven't yet, and give us a follow on our other social media accounts. If you want to trade with us, the link to our Discord server is in the description. On there, we talk through our own trades, help others with their trades, and continue to teach the strategies we outline on our channel. Thanks for watching, and be on the lookout soon for part 2. This has been the Hourglass Trader, where as time passes, we make money.